Welcome to Chapter 9, Implementing Portfolio Decisions, Trading. Investment research may identify what a fund wants to own, but trading determines the price, timing, and risk of actually getting there. This chapter follows a portfolio decision from the manager's intent through order design, market execution, allocation, settlement, and review. We will compare market and limit orders, examine modern venues and dealer markets, calculate implementation shortfall, and connect best execution to evidence rather than hindsight. We will also look at bond trading, fund flows, T+1 settlement, cybersecurity, and business continuity. The central idea is that execution is part of portfolio management, not a clerical step after the interesting work is finished. Markets do not give extra credit for an elegant investment memo. They care about size, urgency, liquidity, and who else noticed the same opportunity. A good trading process preserves as much of the investment thesis as possible while controlling cost, fairness, and operational risk. A portfolio can be right on paper and wrong in the shareholder's account. The paper portfolio assumes the manager buys or sells at the decision price. A real fund pays the bid-ask spread, moves the market with its own order, loses time while the idea decays, and may leave part of the trade unfinished. It also has to route through a fragmented network of exchanges, alternative trading systems, wholesalers, dealers, and bilateral markets. Then the trade must settle correctly, now usually on T+1 for covered U.S. securities. Best execution does not mean finding the single lowest price that appears somewhere after the fact. It means using a reasonable, documented, and reviewed process to seek the most favorable result under the circumstances. That distinction matters when a small quote cannot absorb a large order, or when speed is worth paying for because the thesis is breaking quickly. Trading is portfolio management under a clock. A perfect investment idea can still be mugged on the way to the market. This chapter develops 4 practical skills. First, design. You should be able to translate a portfolio manager's intent into order size, urgency, price limits, venue choices, and an execution strategy. Second, analyze. You should be able to separate spread, market impact, delay, opportunity cost, and fees rather than hiding everything inside one vague number called trading cost. Third, differentiate. Equity, bond, ETF, derivative, and foreign exchange markets do not offer the same transparency, liquidity, or evidence. The tool must fit the market. Fourth, control. You should connect best execution, fair allocation, confirmation, affirmation, settlement, cybersecurity, and business continuity to one trade lifecycle. Some of these objectives require calculation, but the most important skill is judgment. A trader can follow a formula perfectly and still solve the wrong problem. By the end, you should be able to explain not only what order was used, but why it matched the investment objective, the market conditions, and the fund's obligations to shareholders. 4 connected questions organize the module. First, the order. What exposure change does the portfolio manager want? How large is it? How urgent is it? And what constraints matter? Second, the market. Where can the trade occur? Who provides liquidity? What information is visible? And what might leak? Third, the measurement. What did the trade cost relative to a relevant benchmark? And which parts came from spread, impact, delay, or missed opportunity? Fourth, the control cycle. Were fills allocated fairly, details matched promptly, cash and securities settled, and exceptions resolved? These questions form a chain. Poor order design cannot be rescued by a clever performance report. A good fill that is allocated unfairly is still a failure. And a trade that never settles is not a trade. It is an awkward conversation with operations. The goal is a usable mental model that connects investment intent to the final settled position and then feeds the evidence back into future portfolio decisions. The trade life cycle begins before an order reaches a market. Step 1 is the decision. The portfolio manager specifies the target exposure, rationale, expected horizon, and constraints. Step 2 is order design. The trader converts that intent into size, urgency, order type, benchmark, and venue strategy. Step 3 is execution. The order may be routed electronically, staged over time, crossed, negotiated, or worked through dealers. Step 4 is allocation. Partial fills and scarce opportunities must be assigned fairly across funds and accounts under an objective policy. Step 5 is confirmation and affirmation. Economics, account details, and settlement instructions must match quickly, especially under T+1. Step 6 is settlement and reconciliation. Cash and securities move, while fails, breaks, and position differences are investigated. Think of the process as a relay race. Every handoff changes who has the information and who owns the control. Dropping the baton after a brilliant first lap still loses the race. The audit trail should connect the original decision to the final position. Order type is a choice between different kinds of risk. A market order prioritizes immediate execution, but in a thin or fast market, the price can move farther than expected. A limit order controls the worst acceptable purchase or sale price, but it may never fill and can reveal interest. Stop and stop limit orders activate after a trigger, yet a gap can produce a result far from the neat line on the chart. Volume weighted and time weighted strategies, commonly called VWAP and TWAP, spread trading across volume or time. They reduce some discretion, but can become predictable. An arrival price strategy focuses on the market price when the decision reaches the trader and is useful for measuring shortfall. Block trades and requests for quote can improve certainty for size, especially in dealer markets, but they depend on competition and information control. A market order in a heavily traded index stock is not the same animal as a market order in a small company 5 minutes after earnings. No order type eliminates risk. It chooses which risk gets priority. Modern market structure is a network, not one exchange floor. Lit exchanges display bids, offers, and order books. Alternative trading systems and dark pools offer non-displayed liquidity and conditional block opportunities. Wholesalers internalize much retail flow and interact with institutional liquidity through different economics. Algorithms slice and route orders across venues using rules, data, and real-time feedback. Dealers commit capital or intermediate trades, especially in bonds and derivatives. Market data feeds and consolidated information support routing, timestamps, and later review. The best visible quote is therefore only one clue. It may represent a small amount of stock, disappear before the order arrives, or fail to reveal a larger buyer or seller in a non-displayed venue. Venue choice changes fill probability, price, information leakage, and counterparty exposure. The old movie image of traders shouting on one floor is memorable, but it is not a complete map of today's market. The modern version is quieter, faster, and occasionally just as chaotic, only now the shouting happens inside servers. Implementation shortfall measures the gap between investment intent and realized execution. Start with the decision price, the price available when the manager decided to trade, then compare the return of the actual position, including any portion that was delayed or never completed. The shortfall can be organized into spread, market impact, delay, opportunity cost, and explicit fees. Spread is the cost of demanding liquidity relative to a reference price. Impact is the movement caused by the fund's own buying or selling. Delay captures market movement before the order is released or finished. Opportunity cost is the return lost because the desired position was not fully established. Suppose a manager decides to buy at $50, the average fill is $50.25, and part of the order remains unfilled while the stock rises. The cost is not just the 25 cents on completed shares. The missed position matters too. Moving slowly may reduce impact but increase opportunity cost. Trading cost is a trade-off, not a coupon code. Pre-trade analysis estimates what execution may cost. Post-trade transaction cost analysis tests what actually happened and whether the process should change. Before the trade, the desk studies average volume, spread, volatility, depth, fragmentation, and the number of days required to complete the order. It also estimates alpha decay, how quickly the expected return may disappear if execution is delayed. The desk can model passive, normal, urgent, and stress scenarios. Afterward, the result must be measured against a benchmark that matches the objective, such as arrival price, the close VWAP, or the original decision price. The review should examine fills, price reversion, information leakage, routing, broker performance, and conflicts. The most valuable step is the feedback loop. Evidence should influence future position sizing, liquidity limits, broker lists, and algorithm settings. Transaction cost analysis is not useful when it becomes a scorekeeping contest. If the benchmark is selected after the trade because it makes everyone look good, that is not analysis. That is improv with spreadsheets. Best execution is a process standard, not a promise that every trade will achieve the day's lowest observed price. The review considers price and total cost, speed, likelihood of execution, available size, market impact, information leakage, broker capability, and the condition of the market. A displayed quote may be the lowest price, but cover only a few shares. A dealer offering a slightly different price may provide certainty for a large bond trade and reduce the risk of broadcasting the order. Governance evidence matters just as much as the individual fill. The fund should have written policies, defined responsibilities, an approval process for brokers and venues, periodic execution quality reviews, conflict analysis, and a method for escalating exceptions. A strong process can produce an unfavorable outcome when the market moves unexpectedly. A weak process can occasionally get lucky. The test is not whether the trade looked brilliant in hindsight. The test is whether the decision was reasonable, documented, and consistent with shareholder interests based on the information available at the time. Equity and bond trading use different liquidity architectures. Listed equities usually trade through continuous electronic order books with displayed and non-displayed venues, standardized shares, centralized clearing, and rich pre- and post-trade data. Volume and volatility provide useful inputs for estimating market impact. Corporate and municipal bonds are different. They often trade over the counter through dealers and requests for quote. Each issuer can have many distinct bonds, and an individual issue may trade infrequently. Displayed depth is limited, and liquidity depends on issue size, dealer appetite, inventory, customer flow, and the market environment. Trace improves post-trade transparency, but a reported bond trade may already be stale by the time the next institution needs to transact. Equity transparency can also mislead because a visible quote may be shallow or fleeting. The lesson is not that one market is better, it is that evidence must fit the structure. A bond's last trade can be old news, while an equity's live quote can be a very small promise. Mutual fund trading includes a complication that a separate account may not face. Shareholder flows. The manager is implementing investment views while also absorbing subscriptions and redemptions. New cash can create drag if a rising market moves before the money is invested. Redemptions can force sales at a time when conviction or market liquidity argues for patience. Internal or external crossing may reduce cost when independently determined buys and sells match, but fairness and pricing controls are essential. Partial fills and scarce opportunities must be allocated under objective policy, not according to which portfolio manager complained loudest. Tax lot selection can change realized gains and after-tax results. Cash, futures, credit lines, and highly liquid holdings can support flow management, but each has a cost or risk. The fund manager, therefore, manages two clocks, the market's clock and the shareholder's cash flow clock. In a quiet market, they cooperate. During stress, they may become roommates who suddenly discover they have very different standards for cleanliness. T+1 compressed the post-trade clock. Most covered U.S. securities transactions moved to one business day settlement on May 28, 2024. On trade date, execution occurs and settlement details begin moving immediately. By the evening, managers and brokers need to finalize allocations and economics. Institutional trades should be matched and affirmed as soon as practicable. On T+1, cash and securities exchange, and any fails, cash differences, or position breaks must be resolved quickly. The shorter cycle reduces the time that unsettled exposure remains in the system, which can reduce counterparty and market risk. But it also removes the extra day that firms once used to fix bad account data, missing instructions, or late allocations. T+2 often gave operations tomorrow. T+1 asked for tonight. The practical lesson is that settlement reform is not only an operations project. Trading, portfolio management, technology, custodians, brokers, and data teams all have to behave as one process. Trading resilience now includes cybersecurity, vendor dependency, and data integrity. A fund can be ready to trade while the market is open and still be unable to act. The order management system may be unavailable, entitlements may be wrong, or a coding error may route an order incorrectly. Market data feeds can become stale or inconsistent. Broker connectivity through the FIX protocol, portals, or voice channels can fail. Credential theft, ransomware, data corruption, and denial of service attacks can interrupt execution and settlement. That is why manual fallback procedures matter. Critical trades need tested approval limits, backup communication channels, alternate brokers, and a clear audit trail. Business continuity plans must also address regional outages, remote work, key person coverage, and concentrated third-party providers. Financial markets have repeatedly shown that software can move money faster than a human can notice a mistake. Resilience is therefore part of execution quality. The backup plan should be practiced before the primary system decides to take an unscheduled personal day. Consider a fund that must sell a position equal to roughly 12 days of normal trading volume after the investment thesis breaks. Other active managers own the same name, and earnings are 1 week away. The obvious instruction sell it is not yet an execution plan. First, define urgency. Estimate the expected loss from waiting and compare it with the impact of moving quickly. Second, segment the order. Search for block liquidity, conditional venues, algorithms, and negotiated opportunities rather than sending the entire position into the visible market. Third, control information, limit unnecessary disclosure, monitor adverse price movement, and evaluate whether broker behavior suggests leakage. Fourth, escalate limits when normal participation rates or position rules no longer fit the risk. Document why the exception is reasonable. The fund may accept higher impact because the thesis is deteriorating rapidly, or it may stage the trade if the information risk is lower. Large orders are like secrets. The more people who know, the more expensive they can become. Execution protects the exit without pretending the exit can be painless. A disciplined execution plan has 6 parts. First, objective. State the exposure change and the investment horizon. Second, urgency. Estimate how quickly expected alpha decays or risk accumulates. Third, liquidity. Assess realistic volume, spread, depth, dealer interest, and block capacity under normal and stressed conditions. Fourth, strategy. Select order types, venues, brokers, algorithms, participation limits, and price constraints that fit the objective. Fifth, controls. Define approvals, fair allocation, information barriers, conflicts, and settlement responsibilities before the trade becomes hectic. Sixth, measurement. Choose the benchmark and transaction cost evidence that will determine whether the process worked. These parts force the team to make the trade-off explicit. A low-cost strategy that leaves the fund exposed to a collapsing thesis may be false economy. An urgent strategy that sprays information across the market may pay far more than necessary. The plan should be chosen before hindsight makes every alternative look obvious. Hindsight is the only trader that always gets a perfect fill, and fortunately, it is not allowed to manage money. Now apply the framework. An equity fund owns 6% of a small company's public float. A key customer has terminated a contract, the market has only partially reacted, and the thesis is broken. The position is $28 million, while average daily volume is 4 million, so the fund owns about 7 days of normal volume. Borrow is tight, and several peers may be holding the same stock. First, estimate alpha decay. What could happen if another announcement fully prices the bad news? Second, estimate market impact. How would different participation rates, blocks, conditional venues, and price limits change the path? Third, identify controls. Who can approve a higher participation rate? What information barriers are needed? And how will allocations and broker contacts be documented? Fourth, build a stage plan with a clear rule for increasing urgency if price, news, or liquidity deteriorates. Pause the video and write a recommendation. This is not a one-click sell order. It is a controlled exit project. Defend the trade-offs, identify one missing fact, and explain what would cause you to change the plan. Pause the video and answer 4 questions. First, what is implementation shortfall? Is it the fund expense ratio, the difference between the decision price paper result and realized execution, the settlement date only, or broker commission only? Second, what does a limit order prioritize? Guaranteed execution, a maximum purchase or minimum sale price, no market impact or settlement certainty? Third, what changed with T+1? Was NAV calculated hourly? Did most covered U.S. securities begin settling one business day after trade date? Did all funds become ETFs? Or did bond quotes become centralized? Fourth, what is best execution? Is it always the single lowest observed price, a reasonable and reviewed process seeking the most favorable result? Under the circumstances, the use of one broker only or a guarantee of positive return? Pause now. The answers are the full gap between decision and execution, control over the worst acceptable price, one business day settlement, and a reasonable process standard. The mechanism matters more than the letter choice. Carry 6 claims forward. First, trading is investing. Execution determines how much of the portfolio insight reaches shareholders. Second, urgency has a price. Moving faster can raise impact, while moving slower can raise delay and opportunity cost. Third, markets differ. Equities, bonds, ETFs, derivatives, and foreign exchange require different evidence and tools. Fourth, measure the full gap. Implementation shortfall includes spread, impact, delay, missed opportunity, and fees. Fifth, T+1 requires speed. Same-day allocations, accurate data, and prompt affirmation are now core operating capabilities. Sixth, resilience is part of execution. Cybersecurity, market data, vendors, systems, and manual fallback can determine whether the fund can trade at all. The larger lesson is that a trading desk does not merely press buttons. It converts investment intent into a controlled market action and then produces evidence for the next decision. The market does not give extra credit for elegant spreadsheets, but it does send invoices for bad implementation. Next, we examine how funds use ownership rights through voting, engagement, and stewardship. This final page is the refresh register for Chapter 9. Pausen and Hamaker provide the operating architecture. The SEC materials explain the T+1 settlement rule, order types, and regulation NMS. FINRA provides the best execution framework and trace bond trade reporting. DTCC and the Investment Company Institute document the settlement transition and industry implementation. These sources answer different questions, so students should distinguish a regulation, an official market, database, an industry implementation resource, and investor education. Do not read the web addresses aloud or memorize them. Learn which institution owns which part of the evidence and recheck time-sensitive practices when the course is refreshed. Trading rules and technology evolve, but the durable questions remain. What did the manager intend? What market was available? What did execution cost? Was the allocation fair? And did the trade settle correctly? Chapter 10 moves from funds as traders to funds as owners. We will examine proxy voting, engagement, stewardship, and the governance power created when millions of investors pool their shares. Their